Welcome, everybody, to the 24th episode of Crossing the Line with Greg Heym. And, Ray, what song comes to mind? We talked about this last week. We couldn't find a song with 23 in the title, so guess what? We all want to be sedated, as the Ramones sang. And you know, you won't have to look for sedation because this is an economics podcast. We may provide that for you right away.
Yeah, I'm sedated already.
See, and speaking of sedated, we're joined by Noah Rosenblatt, who is the founder of Urban Digs, a site with a lot of statistics on there and a lot of analytics. And welcome to the show. We've been dying to have you. We've known each other a while.
Thank you for having me.
Today is May 6th. We always like to say that in case something dramatically changes tomorrow. We could say, we told you we filmed this on the 6th. How was your weekend, since it is Monday afternoon?
I had a good weekend. I did some hiking and some biking and some working in the backyard, a little exercise this week.
Oh my, that's a lot of exercise.
I know, too much. I'm exhausted talking about it.
I watched the Rangers beat Carolina. That was really good.
That was fun.
And I watched a couple of great documentaries, but one on Blood, Sweat, and Tears, the great horn band of the late 60s, who disappeared off the face of the earth, and the documentary explains why. So I'm not going to spoil it for anybody, but you can find it on Amazon. It's pretty interesting.
Is that the name of the documentary?
It's called What the Hell Happened to Blood, Sweat, and Tears. Basically, they were blackmailed into doing a tour of Soviet bloc nations, and the core of their audience were people that didn't like the government here or there. So even though they had the #1 album and 3 mega hit singles and beat the Beatles out for Grammy of Album of the Year, their career kind of fizzled after that point because they were the man all of a sudden, instead of being the counterculture, they were government flunkies, even though they were forced to do it. So yeah, watch it. It's pretty interesting. And we are here in beautiful Studio 1873, our home, right outside my office, very convenient. Tastefully decorated by our friends at the Everset, so thanks to them.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
So we'll start, as we always do, because we don't have enough time to go into development and change the order of the show. So we'll start with our line items, which are basically what was in the blog on Friday, and it was all about the job report. Now, we got a terrible GDP report the week before, which showed the worst possible scenario, which is slower economic growth and rising inflation, which leads people to think of a word, stagflation. The problem is there's one thing missing there, and it's an important thing. Unemployment has to be rising, and unemployment is not rising. Jobless claims are near historic lows, and there's still 8.5 million jobs out there. So no stagflation, just a really weird report.
Bad payrolls print on Friday.
So we come to Friday, and I'm nervously waiting for the numbers to come out, and I got to write the blog real fast so we get it out while it's still relevant. Payroll's only up 175,000. Look, in the real world before COVID, you'd be happy with that, especially if your unemployment rate is 3.9%. You'd be like, all right, how many more jobs can you add? But when the Dow Jones forecast is looking for 240 and you had over 300,000 the month before, it's showing a softening potentially. It's 1 month. We know, and you know this because you have analytics for everything. Monthly data is volatile, and you need to see a couple months more than this to be a trend. But when you have job growth less than expected, the unemployment rate ticked up to 3.9 from 3.8, not a big deal. Wages rose less than expected too, which is maybe the most important thing here. So hiring slowing, unemployment rate going up, wage growth slowing, exactly what we wanted to hear, exactly what the Fed wants to hear. See, cooling labor market. We don't have to do anything. Was that your conclusion when you first saw the headline numbers come through?
I feel like it's a seesaw right now. I feel like everything is just back and forth, and for the last 4 months or so, we've kind of walked back a lot of those rate cuts, right? Over the last 4 months. Or
all of them.
All of them, right? It got to the point where I think there was no cuts for a little while, a couple weeks ago, until that payrolls report and the soft GDP. So, I feel like this is something that the markets are bipolar on. And I feel like that they're going to go back and forth a few times until we actually get to the real move, whenever that may be.
I mean, it's going to be, we're going to dread every month when this stuff comes out. It's my whole life is about when the first Friday of the month, and then when the PI brothers, as I call them, CPI and PPI come out, and then PCE comes out. Like that's controlling my life right now. It's kind of lame when you think about it.
I feel like that they're just going to normalize, though. I feel like that we're setting up for a situation where they might cut once, they might cut twice, maybe they'll cut 3 times. But I don't think they're going to go on any kind of sustainable, aggressive rate cutting campaign. Do you?
No, well, I mean, the thing that's really important about this is not that the job growth was muted, because, that isn't really driving inflation. Wages can drive inflation. One of the things that we've noticed in the last couple of reports is the participation rate has gone up a little bit. Not a lot, but a little bit. So if you have more people looking for work, those 8.5 million jobs that are still out there are easier to fill, and you don't have to pay as much. So wages had been rising faster than prices from May of 23 to March of this year. So April, exactly the same rate, if you go by the headline CPI number, whatever. So that's good, because then we don't have more upward pressure on prices. And it was the lowest annual increase in wages since June of 21. So that's good too. And look, people like Greg, are you cheering bad news? Are you rooting for bad news? No. And remember, keep in mind, 175,000 jobs is a very decent number considering how long we've been adding jobs for and how low the unemployment rate is. By the way, the unemployment rate has been under 4% since February of 22. And again, I'll give the exact number, still 8.488 million available jobs out there. So, yeah, things aren't what they used to be, but from a historical perspective, they're looking real good. About as good as my New York Rangers right now.
They're looking good.
They're looking great.
Yeah, they're looking great. I just don't know if he cuts, it's almost like a preventative cut kind of thing. I don't think that he has the data to actually go on this sustained campaign. So anyone that's really looking for drastically changing rates, the only way you're going to get that is if something breaks. And deep down, we don't want that.
Right. So that's a good transition into the other big story of last week, which is the Fed does nothing, which has been the ongoing story since July of last year. They haven't touched rates. But they said 2 noteworthy things, one in their statement and one in the press conference afterwards, that I never listened to because I don't find economists all that exciting. And Jerome Powell is not an economist.
Aren't
and
you
not
an
exciting.
economist?
Yeah, but I'm the exciting economist. That we have to change the name of the show. Come on. Do you see Jerome Powell crossing lines on the show? I don't think so. See, it says it right here on the mug.
Back here.
Yes, well, we pay them extra to do that. They noted a, quote, lack of further progress on getting inflation. And I liken this to the red zone in the NFL. They've been stuck at, like the Jets offense, they're stuck in the red zone. Now, the GDP report was like a holding penalty, and now they're back to the 30. So they're not even it. And now maybe they've crept back into the red zone, but getting it from 9 to 4 seemed to be pretty easy. Now to get a 4 to 2 is going to be the tricky part.
Yeah.
And one of the things that I said in last week's show, I think it was last week, that honestly, based on the GDP report and the inflation data, you're more likely to have a hike than a cut this year. But Jerome Powell came out and said that their next move is, quote, unlikely to be a hike. So they're trying to tell people, look, just roll with it. Leave it alone. Don't watch the boiling pot, right? It's not going to boil if you watch it. I think that they do nothing the rest of this year. I think let things normalize a bit. Inflation, yes, has hit a rough point, but the economy does not need. All right, 1.6 is weak GDP growth, but remember, almost a full point was subtracted by net exports. So consumption is still running about 2.5%. I say just leave it alone. And it's funny, I look for just laughs at the Atlanta Fed's GDP now. Yep. Their much too early forecast for second quarter GDP is 3.3%. Now they had it wrong. They were looking for over, I think it was 2.5 or 2.6, as a lot of people were. But it's that equation, and I don't want to talk about equations for 2 straight weeks, but remember, there are things that go in there that aren't about what we buy. There's what the government does. There is the inventory buildup or lack thereof. You build up inventories 1 quarter, you're unlikely to get that boost, and then net exports. So I think that they're going to keep it the way going to keep rates steady the rest of the year. I don't. The more likely shock, to go to your question, is really more about continued bad inflation numbers. I don't think things are going to turn around. The economy is going to take off like a rocket. I think consumers are still spending. I don't know how.
Yeah.
You think of the trillions, over $1 trillion in credit card debt at record high rates. It's scary.
Yeah.
And student loan payments that restarted, but now, I mean, do you want to talk about uncertainty? The biggest uncertainty we have right now is, do you have to pay your student loan payments or not? Because they keep trying to get rid of them for different classes of people. But I think we're in this unprecedented situation, right? We've never increased the money supply by 40% before.
Yeah, well, I mean, that's the thing, right? I wonder how much of that pandemic stimulus is still kind of powering wherever we are.
Well,
right
we
now.
call that the excess savings, right? And there's been a lot of studies that said that stuff ran out.
Yeah, it seems like it ran out, right? And now you got the fiscal side. They call it fiscal dominance is what they're using now to power it. Who knows? You got that reverse repo facility. Who knows? There's liquidity coming from there. I understand. I don't know how they're doing it. I don't know how it's holding up.
Well,
so
I saw a new term. It's called spavers. Have you seen this?
No, haven't.
People that spend to save.
Oh.
It's like you say, I'll transfer this credit card to save money or something like that. And, we've invented a lot of new words during this cycle that we've never had before. And we've talked about way too many kinds of inflation. So it's kind of a crazy world out there. They throw the book.
Sticky.
This sticky inflation. Well, the biggest driver of inflation continues to be housing, right? And you look at now the fact that gas prices have reversed and gone up when they were driving the headline numbers down. When core inflation is rising above the headline number, you have a problem, because by definition, core inflation isn't volatile and doesn't change much, right? So that's been the concern. Now we have super core inflation. It's too much inflation. I'm being crushed by inflation, ironically.
All of these things have come way down from where they were
They
few years
have.
ago. But the problem is that now they're not going down anymore. They kind of stopped at a level that's above what the Fed kind of is looking for. So that's the problem here.
And the 2% is a moving target. Like they you can hover around it. They said we don't have to get it to 2%.
Yeah.
But it depends. You look at PCE or CPI or whatever 3-letter measure you want to use, it's not 2. There's not a single one of these inflation measures it's 2. And with the core numbers higher, it presents a problem. So now we get to talk about what this means for housing. But before we do that, we have to take a moment for this break.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
Okay. And we're back with my good pal, Noah Rosenblatt. So we're all about housing, right? That's our business. That's what we talk about. The end of last year, mortgage rates declined over 1% from November, December. I was doing the show every week going, yes, we're going in the right direction. Because again, inflation was coming down and economic growth was decent. And then this year, we started the year at like 6.6. Now we're over 7. And, people are very unhappy and business is not great.
They giveth and taketh away.
So do you think, though, that people are accepting a 7+% mortgage rate?
Well, I'm starting to notice a downtick in our volume right now, which is not usually what happens this time of year. We usually have May is usually a good month. It's our second best month usually.
Right.
So I'm wondering if we're now starting to see the effects of those higher rates that happened over the last 3-4 months. We did have a good late January, February, and early March, and I think it's because of those rates coming down.
Right, because of the lag. I mean, you're looking a couple months before you...
Exactly. So, I mean, I do think it's affecting our markets. I mean, you step outside of our markets, though, in New York City. We have a little bubble here, right? You look at what's going on outside. Some of those housing markets are doing incredible.
Well, incredible is a relative term, though, right? They have no inventory. Prices are still going up because there's no inventory. And there are bidding wars everywhere,
Yeah.
and there's nothing to sell. Our Connecticut offices, Palm Beach, Hamptons, here in New York City, we have a healthy level of inventory.
Yeah.
There is stuff to buy, but
Yeah.
we're seeing
Prices are down.
Prices are drifting down because they have to. Yeah. I mean, you need a correction at some point, to get the market moving again. And COVID brought that sort of, but prices didn't move a lot. We had, a market that was kind of flat before COVID. The 18 and 19 were weak years. COVID happens, decimates New York City, but prices don't go down. We reopen later than everybody. And then we hit the 21, a year we all like to repeat over and over again.
What a year.
But prices don't go up really because there's a lot of inventory. The rest of the country, boom, boom, like a rocket.
I mean, we saw prices go down like 8-10% in COVID, but it's hard to track it because those deals that were signed during COVID, they took 9-10 months to close.
Yeah.
You know what I'm saying? So like you have to go way out until like early 21 to even see some of the closing pandemic contract signed deals. It was a really tricky time.
It's always a moving target to try to do that because you got to wait until usually sometimes the sales are recorded, know what the actual prices were. But having the healthy level of inventory was good because you had stuff to sell. We sold a lot of it. It kept things from getting too happy or too upset. It was nice and level. But now, the contract numbers for last week were not good.
Yep.
The declines were under 2 million, which are interest rate sensitive, which I guess makes sense. But it's hard because the rate situation is not going to change, and people have to accept that and remember that even at 7.2, mortgage rates are lower than the average over the last half century, which is closer to 7.8.
Yeah.
So where do we go from here, I guess?
Well, I mean, we already got hit. I mean, that's something different. No housing market can kind of say that. This has been a long this has been a 2-year kind of a correction. I mean, we've had low volume for like 21 out of the last 23 months or something like that, and we're at the end of it. So a lot of us are exhausted. We're definitely better now.
Me and Noah had hair when this started.
Yeah, totally got. I mean, today's environment is a much better environment than wherever we were 5-6 months ago. That's for sure. I mean, last year was rough, and like last September, October, November, that was like kind of the bottom of it. So wherever we are now is definitely better.
Well, there's negotiability in the market.
There's a little more negotiability. There's more deal activity. I feel like prices, we did decline. I feel like prices clawed back a little bit more today. So you're not down as much as we were maybe 5-6 months ago. But I still feel like this market is very bipolar. I mean, I'm talking to a lot of agents, and I'm hearing extreme sides. I'm hearing from some agents that they cannot move property. And then I hear from other agents how they're having bidding wars and things are selling. And I guess there's attributes to both sides. I think the market is still putting a heavy penalty on anything that requires renovation.
Well, that's and those pre-war co-ops are particular. We had Michael Vargas on a couple of weeks ago, and he's saying
Park Avenue pre-war
that's like 10-year ago prices or longer. And townhouses have this problem too because they need a lot of work. Yep. And maybe there's signs of hope. But we look at the national scene. Pending home sales, which are based on contract signings, were up last month sharply. New home sales, which are also based on contract signings, were up. So maybe people are saying, well, in areas of smaller supply, they have to make a decision because they've realized that waiting is hurting them because prices are only going up and rates have been drifting up.
The rental markets.
And the rental markets are still, well, look, that shouldn't be a surprise, right? You have very solid job growth, even in thinking about last month, the 175, that's not bad. Yeah. It's not the 305 you had the month before. But solid job growth for all these months, you would expect that the demand for rental housing, and as people are expected to be in the office a little more, that should boost some of the other markets. Like I would think here, we talk about the return to office rate, which depending on which study you look at is either 50 or 60%, maybe a little more. But it's not budging. It really looks like it's plateaued, and we need that, right? You need restaurants to do business and retail to do business, and the transit system to be funded by people traveling. And you go out to lunch in Manhattan, and the restaurants are pretty empty. At night, they're very crowded.
Yeah, and I mean, I wonder if New York is in its own little kind of isolated thing going on here. We got the commercial market that's still kind of, as you said, distressed in some sense. I mean, probably 50% of where it was or whatever. And we do have some policy situations, and we do have some other things going on in the city. And I wonder that's why we've been having this disparate trend.
But the funny thing is, New York State, New York City, their finances are much better than expected. The city just made revisions to their budget because they have more revenue, more money than they thought they were going to have. Wall Street paid almost $34 billion in cash bonuses last year. The job growth has not been as quick to come back as around the nation. And there are challenges here in New York City, and some of the things in the budget did not help, like good cause eviction.
Yeah.
But, we have a 421A replacement.
Yep.
And
that was recent, right?
Yeah.
That just came out.
That's just in the budget, yeah. But it's geared towards affordable housing, but we certainly need plenty of affordable housing. The rental vacancy rate is 1.4%, I think, as of the last housing and vacancy survey in New York City.
I mean, like structurally, there's no reason why this market cannot have a recovery. I feel like that it's been such a long time. A lot of people feel like it's just not going to happen. You know what I'm saying? That psychologically, the exhaustion setting in a little bit. I mean, again, it's been 2 years, since we've had a decent market.
Right.
And that was like, what, spring 22?
Well, that was 22 felt like the market had shut down, even though it was great, because anything compared to 21 is going to be terrible.
21 was just crazy. But yeah, I mean, and this is what I wonder about. I think Manhattan, New York City in general, we might have been exposed to this pandemic situation much more than obviously other suburban housing markets. The urban markets, there's been a move out kind of a thing.
Right.
And the question is, like, where do we go from here? So do we just stay at this level for a while, or is there going to be a recovery, a resurgence, a move back? And at some point, I think there will be. I mean, I don't know if it's going to happen in 24. It probably won't. I don't know if it'll even be 25. But at some point, you will start to see the commercial sector in Manhattan come back. You'll start to see foreign businesses and foreign investors come back. And we might have to go through a little thing first.
Yeah, I think, the flight out of New York for a variety of reasons. I mean, there's always people that are going to leave or move here. But for people that might have thought, well, I'm going to go to Connecticut, or I'm going to go to Westchester, or I'm going to go to Florida, they realize it's very hard to find something in those places. And even in Florida now, some of the costs of home ownership have skyrocketed. Yeah. I mean, I live in Long Island, and my homeowners insurance got ridiculous, and I couldn't even find anybody. I'm sorry, I complained about this a couple of weeks ago on the podcast, but I live close to water, but not in a flood zone. My house was not damaged at all during Sandy, but because I'm south of Route 27 or Sunrise Highway, where I live in Long Island, almost nobody wants to write a policy there.
Yeah, you're in that zone probably.
It's a really big zone. Yeah. If they were just circling a couple blocks around the water, the flood zones I would get. But if you know anybody who lives in Florida, I do, their homeowners insurance policies are insane.
So that's a thing. I mean, the homeowners insurance policies, I mean, I'm sure taxes are starting to go up. I'm sure the cost of living for everyone's starting to go up, is starting to get pinched. At some point, this all means something. I really do wonder whether or not we're going to look back at this and a month or two ago may have marked maybe the top of the suburban housing market. I wonder if the suburban housing market is in the process of rolling over off that top right now as we speak.
I guess the question is all the demand been filled? Because with the job growth over the years, a very short recession, a very quick recovery in most areas from the pandemic. We couldn't even show property till the end of June. Mm-hmm. They were hitting the ground running, selling everything. It's hard to pick. Demand is always hard to measure. That's why, and I know we've talked about this. I like to look at inventory.
You're a supply guy.
I'm a supply guy, a supply sider.
Demand guy.
Well, you demand things. I want to supply things. So I'm the nicer guy. I'm thinking of other. No, well, I look. There's always shadow inventory, but I can't worry about something that may or may not exist, like UFOs or something like that. I say it's the most honest indicator. If you have to pick one, we want to see all of them. You want to see 8 million data points. I'm not that thorough.
No, it's not that. It's just that, like, you know what? I mean, here's what I've been you learn, right? And you adapt. I like demand because typically in low volume situations, it's harder to sell. Typically, right?
Right.
If you're trying to sell your property and there's normal supply, but deal activity is well down, 50% or whatever down, 40% down, and there's no buyers, you're going to have to compete with just normal inventory. Even if it was low inventory, you'll still have to compete if the demand is lower. And I used to think, and the data did usually support this, that when the deal volume fell, it got harder for sellers to sell property, and they had to react. They had to lower prices. They had to hit a bid. Sometimes those bids were gap down bids, and that's what dictated a 10% decline or a 15% decline, is because you have someone with $1 million asking price hitting a bid of 900 that they normally
And by
wouldn't
bids,
do.
no, it means offers.
Yeah,
Let's
offers.
He's talking Wall Street speak.
But I'm wondering if, like for example, deal activity volume went down in most of the suburban areas, but all the prices went straight up.
Well, and think about it. Mortgage rates double in under a year, right? They go from
Demand
3 to
goes
6.
down.
Prices keep going up
Prices
because
go
there
up.
is nothing to sell. All right, so when you say you look at demand, so what metrics are you looking at to measure demand? See, all I have to do is do a search of active inventory, and I know what inventory is.
Yeah. I'm looking at weekly contract signs. I'm comparing that to this week, previous year. I'm comparing it to last week to see what the trend is. I'm looking at 30-day rolling contract activity, moving windows, just to see it. Like so it's what, May 8th or May 7th today, whatever it is. So
May 6th, but who's
6th,
counting?
I'm getting there.
We're supposed to be statistical geniuses here. I don't even know what date it is.
So
I
April.
only know that because it was my brother's birthday yesterday. That's not the reason.
I should have Cinco de Mayo was yesterday.
Happy belated birthday, Billy. Okay.
Happy birthday. But so April 6th to May 5th kind of a thing. It's a 30-day window, and it moves each day, so we can keep track of.
Now, the way we
what's
do
going
it, because when you carve up economic data, weekly is, I guess with stocks
noisy.
you can look up daily,
Yeah.
but weekly data can be very noisy, volatile.
Very noisy.
So you smooth it out. That's why sometimes you'll hear 30-day moving average, 6-month moving average to try to smooth out
just to
those
get a little more
bumps.
data in it, and you could trust it a little more. And I mean, more importantly, is we're a seasonal marketplace, right? Typically, if you look at
It hasn't felt that way for the
I
longest
know.
time,
Well,
but
but last year was bad also. See, we usually have a good spring season. We usually have February to March, March to April, April to May. Like it goes up, and then we stay up,
Right.
and then we go down. So we climb the mountain, and then we stay at the top, and then we go down. What's happened last year was we went up, and then the regional banking crisis happened in late March. We went straight down in
that's
April.
fine now. Don't worry about it. It's
But this year we're following the same thing. So now it went up for February and then down for March.
well,
and
like
down
you
for
said
April.
earlier, that could be the rates too. That the rates
Doesn't matter. But
sharp
it is what,
decline.
It is what it is.
I know it's
Whatever's going on, and so like I wonder if for those sellers out there that are like, I'm going to list for the spring season, right? They may be unaware that things are starting to cool, and they're like, all right, I'll just stay on the market for spring, and then once June comes, I'll lower the price.
So we get asked that question a lot because this is the time of year where as you get closer to actual summer, you're like you said, we're still on the market or we're thinking about it. Do we want to jump in this market? Should we wait till September? Wait till the fall. The last couple of years, it's been a no-brainer to try to rent it to buy yourself some time, but maybe that's not the best move now. I would have bet my life almost, but not my Ron Guidry bobblehead. I don't bet that. That rates are going to be lower in the fall because they would have to be, right? There's a couple of economists that I follow that think a recession is still not out of the realm of possibility. And they point out that, the economy tends to look really good right before recessions. It's not, you say, well, we'd have to slow down first. Well, guess what? Last month could be the beginning of that. Who knows? The consumers are tapped out. Consumer spending 70% of GDP. It could very easily go south quickly. Not trying to scare anybody, just trying to lay out all the scenarios.
It could, yeah.
Just like the Knicks season could go kaput after a great win over Philly. But I mean,
September's far away.
I know.
And if I was someone saying, do I list now or do I list in fall, right? I mean, there's a lot of stuff. You got the election that's coming up.
Wait, there's an election going on?
You got the
Did
rates.
you know this?
You got the election. You got the rates. You have we don't know the rate uncertainty. We don't know the risk on, risk off, equity uncertainty kind of thing. We don't know what's going to happen with.
All right, let's talk about stocks for a minute since you mentioned that, right? We had the GDP report which crushed stocks the day it came out, and then the market was like, all right, we're over that now. Friday, big gain. Last week, I guess with the jobs report being what it was, another good week. What's the problem? I always say it has no memory, right? It's all about the future.
It is.
There's a fringe movement of economists. I'm not part of it, although it's very interesting. I'm fringe in other ways, but not when it comes to this. And a lot of economists are saying that the rate hikes are actually the reason the economy has done so well lately. And their argument is that, with the savings rate, people forget about, when borrowing rates go up, the savings rates go up. And that spread between when mortgages were 3%, you were getting maybe 0.25% on your money. or even less if you were lucky. Now you might be borrowing at 7%, but you might be getting 5%. And a lot of the consumption is being driven by baby boomers, right? These are the people that have all the money, and a lot of it's in cash. And now they're getting 5%, and they have the money to spend. And they also point out that, look, these higher rates haven't stopped the stock market. They crushed it last year. They were crushing it this year. It's a little volatile lately, but it wasn't that long ago we were setting records.
I know. So we know about the lag, right? It takes a year and a half for these rate hikes to really funnel through the economic system. Now we're approaching that threshold right around now.
Well, the rate hikes started 2 years ago. I mean, it wasn't like
that's what I'm saying.
If it's 6 months to a year for each one.
We haven't been at 5.25, 5.50 for a year and a half, right? We started from where? 0. Or
0 to 25. They shouldn't have started with these ranges things too. I mean, pick a number. It's a meaningless number anyway because
does anybody know what they're doing? I mean, does anyone know what's going on? The Fed?
Nobody trades Fed funds anymore. The rate's insignificant, but it's more the signal it sends and the other operations the Fed does, whether it's getting rid of its securities. The Fed's losing a fortune now because they're paying banks higher rates of interest. Their assets are paying no interest.
Doesn't matter.
They're like a regional bank a couple of years ago.
Except they can print their own money.
They can actually, and a lot of people say, well, why don't we just print more money? And I tell them to go look up the history of Argentina and we did that in COVID. We printed 40% more money, and we had the worst inflation in 40 years. So
the Fed usually sterilizes when they print. When they create money out of thin air, it's a credit right to the bank system, and the banks typically don't lend that out. They usually keep it in reserves on the
because
side.
We're paying them high levels of interest on it.
Correct.
That was the big change.
But that's the sterilization process in effect. The Fed actually is paying.
So wait, the Fed's laundering money? Is that what you mean by sterilization?
The Fed is paying the banks not to lend. Put it
well,
that way.
we've moved from, we used to have what they called a scarce reserve policy where the banks were only going to hold as much as they needed to hold because they wanted to put the other money to work. Then Lehman Brothers happens, and now we have this excess reserve where we're just encouraging them by paying them these high rates of interest that they're making a pretty good amount of money on that.
Oh, yeah.
The Fed, don't worry about that. It's just the Fed. Who cares? But again, what upset me from the beginning of all this was forget the supply chain issues. That nobody could have predicted with COVID. That was a problem. But just increasing the money supply by 40% alone would have been enough to cause runaway inflation. Mm-hmm. I mean, if Milton Friedman was alive today, he'd be losing his mind. Too much money chasing not enough goods. When you raise the money supply by 40%, there aren't enough goods even before COVID to go around.
That's the thing. See, when you look at the markets right now, do we really see that purge of malinvestment that happened since then? We haven't.
No.
That's like the animal spirits are still kind of in play out there. And
things take time, right?
It does, and that's
to work
the
out.
thing. And that's why we're all sitting here saying, well, it's been 2 years. It hasn't happened yet. Yeah. Right? A lot of people are just sitting there waiting on the recession to happen. It's terrible to think that way. And I know we don't want to talk big words, but I look at credit spreads as my guide to like when that may happen. I don't see anything there.
Well, that's not a big word, but talk a little bit about more what that means.
So it's just credit spreads are just the spread of the rate between a corporate bond and a 10-year treasury. So if a corporate bond is 9% and a U.S. 10-year treasury is 4.5%, that spread is 4.5%.
And that spread is all about risk, right?
Well, which way it goes.
Right.
So like if that corporate bond rate goes to 10 and that U.S. treasury yield goes to 3.5%, that spread is now wider. That's a reflection of a risk-off market.
Right.
And that's bad. So like, for example, in the pandemic, the spreads blew out and went really wide. In the great financial crisis, they went off the charts, right? In the last couple of years, they've been coming in. And right now I look at credit spreads and they're the smallest I've seen in a long, long time, which suggests no credit stress in the system. So that's why stocks are doing what they're doing.
Well, earnings look great.
And that's why this is what.
And it's not just NVIDIA.
The credit markets are reflecting that. Like
right.
The credit markets are reflecting that we don't see any really crazy stress or risk in the system. If the stock market's going to have a 10 to 20% to 30% consistent downfall, you should see credit spreads widen, and that will feed into itself. Like credit spreads widen. It's like, all right, it's happening, but it's not happening right now.
I guess the point you talked about the regional bank problem, which seemed to resolve itself very quickly,
yeah.
right?
The Fed.
Which was really also about mismanagement. It was not about some systemic issue. Mm-hmm. You talk about risk. the people at SVB apparently forgot about interest rate risk and
duration risk.
And duration risk, same thing. I
Even
don't want to use a word like
I know what that means.
Right. And we're buying longer bonds to get an extra 0.25%. That didn't make, and all of a sudden this idea of uninsured deposits started to scare people, right? And then people started asking, for some reason they started asking the economists the question, is my money okay? It's like, when was the last time you didn't get your money back?
Yeah.
It was probably during the Great Depression when you didn't get your money. Now, if you were an investor, that was a problem. But now we're hearing more that maybe we should be a little worried again, because a lot of these regional banks own multifamily housing, commercial housing. And look, as I started at Rebney in 1995, every time there's a recession, you hear commercial office buildings are going to default, multifamily housing defaults. So I tend not to worry about it. But when you see occupancy rates, at some point these leases are going to expire, and then firms are going to rethink. There's been this flight to quality where the Park Avenue space is doing great, but the other, the space that's not Class A space is not doing great, and the ability to convert them would be nice, but everybody we talk to is saying they don't have the floor plates for it, they don't have the windows or whatever. They can pick holes, and there's supposed to be some kind of plan coming, but we don't really have specifics on it. Be nice if we could do 421G like we did downtown. That took care of a 25% office vacancy rate pretty quickly. But downtown, old outdated office buildings are cool. I don't know if that flies here. Do you have any thoughts on? Well, it would be the perfect solution, but I don't think it's going to happen the way people hope anyway.
I don't know. But I'm looking at this whole thing, and there's a couple things I think people need to take into account given the post-Great Financial Crisis world. You have to go back to 2008 when you think about this. First off, I will confirm, because I just actually checked this on our Macro Monday today, commercial mortgage-backed securities defaults are rising. They're not at troublesome levels, but they're rising, and the trend is going up. So at some point, it could be a problem, but right now, it's not. It's only a problem until it's a problem. That's number one. Number two, you have to think about the reaction function of the Federal Reserve in any kind of systemic banking crisis situation.
Well, they acted pretty quickly.
If you go back to the regional banking crisis last year, they reacted very quickly. And you have to think about what the Fed has in terms of their weapons. They have two weapons. They have, on one hand, they have rates, interest rate policy, and on the other hand, as you know, they have liquidity facilities. So when crap
that means places where you can get money.
Yeah, they'll just create all these facilities to lend, basically, so that.
And SVB could have went to that desk and borrowed the money very cheaply and stayed afloat. But they didn't want to signal that they were they were a little weak and a little.
But they stepped in for the people that were going to rescue them. But they had to fail. They had to fail first. So the people they can't send that message, right? So you have to think about this. The Fed could keep rates where they are, and they could provide the liquidity facilities. And the most important thing is that the Fed has experienced the Great Financial Crisis. And again, if they didn't experience the Great Financial Crisis, they may not look at things, but they saw the devil. And they looked the devil in the eye, and back in 2008 and 2009, and they got a glimpse of what could happen when credit stress gets unhinged and something becomes systemic, and that is really, really, really scary.
Well, one lesson they didn't learn from that and other recent crises is if you leave rates low enough for long enough, Wall Street will find a way to cause a disaster.
They'll find it anyway.
Whether it's credit default swaps, savings and loan crises, tech bubbles bursting, because that whole idea of irrational exuberance kicks in, or just a flight to make anything more than 1% or 2%, people will take all kinds of risks. Yeah. And, you get speculation, and that's not healthy. That's not based on reality.
It needs to be cleansed, it needs to be purged, and malinvestment needs to be punished, which happened in the Great Financial Crisis. But when that becomes systemic and it potentially affects the credit system, the machine that powers global economy, the Fed's not going to let that happen. So now in this world that we're playing out, where the commercial mortgage-backed security market starts defaulting to bad levels, now we start to have banks failing, and it's starting to get a little bit systemic, credit spreads start widen, that Fed's going to go right in there. And they're going to go and they're going to do everything they can to stop this thing before. And that's what I think. Doesn't mean I'm right. I just think that the Fed has a playbook, a separate playbook outside of rates.
I'd like to see that playbook because I want to make some corrections to it.
Go take a look at the 2008. I think they did over 70 facilities
Well,
in 2008 until they figured it all out. Like they had to do one here, one
well,
there.
you know, the irony of the whole thing, at least in my opinion, you can disagree. The financial crisis was solved by one stroke of a pen that didn't cost a dime, and that was ending mark-to-market accounting. They suspended mark-to-market accounting in March of 2009 because think about it, you require mark-to-market accounting basically says if you hold securities and they lose value, even though you haven't sold them, you have to mark that down. It'd be like you buy a house for $500,000, you take a $400,000 mortgage, then the price of the house is now worth maybe $300,000. They want you to come up with the $100,000. It was writing off losses that hadn't been incurred yet.
Oh yeah, and
just fixing that, boom, stabilize things like that. People may argue with me. And
no.
You can send those comments to CTL@BHSUSA.com.
That was probably the one piece of regulatory change that allowed us to get out of it.
Yeah.
Because if that didn't change, if you recall, it was $10 billion write down, $20 billion write down, $20 billion write down.
When you first you can't even write them down. You don't know what they're worth. When there's no market for something, and there was no market for these securities, what do you mark them down to? Zero? Yeah. And that's the problem. All right. So
here we are.
Before we conclude, so you mentioned a presidential election. Now, I think it's a lot to do about nothing. I don't think people buy or sell homes. I mean, it's on our minds. People have fears and hopes, and they're rooting for one person to win and the other person to lose, and they're worried what might happen. But these things don't happen in vacuums. You can't isolate Biden's election from COVID. They're going on at the same time. Or, you know, George W. Bush's election during the tech bubble.
Chad,
you know, not the Chad. Yes. Well, it's amazing that you remember. It reminded me like when you used to vote for the All-Star game in baseball. You'd go to a baseball game and you'd have to take a pencil and punch the holes, and that was like in the 70s. And we have no better technology. But or Obama getting elected right after the financial. These things are joined. It's hard to point a value. But so do you have optimism, hope that rates will go down in the second half of the year? And I'm not meaning, I would have thought they would have even maybe approached the high fives. I don't think that's going to happen now for obvious reasons. Yeah. But I do expect that the trend will be lower in the second half. I don't want the Fed to cut rates. I hope they do not. The economy doesn't need them yet. Yeah. And, you know, they're not usually right about big moves like this. Let's be honest.
I have a strange feeling we're going to see some weak economic data right before the election that's going to warrant one or two Fed cuts.
Well,
and then maybe they'll revise the data later on.
My plan was, you know, that they might do it in July.
Yeah.
Get one to shut people up because that's where the markets were March, and then they kept pushing that back. And then wait till after the election. This way you're not playing favorites, even though, like you said, you could cut it in August. That's not going to change the economy by election day.
All this stuff is really meaningless, honestly. These one or two cuts, I mean, what is it going to do, right? At the end of the day, all this is, at some point, there's going to be some cleansing of the economic system, of these excess, of these malinvestments, and the Fed's going to react. And they're probably going to react by cutting rates notably when that happens. I don't think it's going down to zero. Imagine a world where the Fed funds rate is at 5.25 right now. Maybe it goes down to 4 or 3.5 or something like that, because they're not going to want to restoke that inflationary animal spirit.
Well, the problem is they left themselves no room too. When you keep rates at zero for that long, there's no. I mean, you could go out there and buy treasuries and try to flood the system with more money, but you want to leave yourself a little bit.
Yeah, well, that too, and then you got the fiscal deficit. You got a whole bunch of things that are.
Well, you mean that $1 trillion each 100 days that our debt goes up?
Something like that, yeah.
That's kind of scary.
And with rates higher, it makes that, you know, more goes to service of that debt. So I mean, you got all these things going on. It's going to be an interesting thing. It's a great time to be humble and just approach it like, I have no idea what the hell's going to happen.
Humble? What does that mean?
I'm in your camp though. If they cut, I think they're going to cut once. And it's not going to be a campaign. It'll just be like a normalization. But I think no cuts is a very, very feasible situation.
I let the economy try to work itself out, because the more artificial stimulation.
First off, the best thing that could happen is that we have a little purge, a little recession. We cleanse all this stuff.
Stop saying purge. That's scary.
Well, no, it's not. But we purge a little bit. The stock market goes down 10, 15%, 20%. We have a little recession. We cleanse it, and then we set ourselves up for longer-term sustainable growth over many years. We're at a lower interest rate environment.
And recessions will reset housing prices. But again, we're not rooting for it. But
Well,
we're
it
just
doesn't
pointing out-
necessarily mean housing prices are going to get hit that hard. I mean, you just never know what's going to happen. It's very possible that the suburban housing markets may go down during the situation. And for all we know, New York City might stabilize and come up during that time. I mean, it's doing completely different things. Like, expect the unexpected. We would have thought that if rates went up and deal volume went down, prices would go down too.
It would
and
have to.
didn't.
See,
So, like,
that's the thing. Like, people always say, well, what's the effect on rates going down or up on prices? I go, just look what happened last year.
exactly.
You know, rates skyrocketed, prices went up. That doesn't make any sense now, does it?
That's the thing. We don't know what's going to happen.
See, our point is, this is why we said it at the end of the show. We don't know. If we'd have said that before the show, you wouldn't have stayed and listened to the whole thing. So, again, you want
for staying this
to send hate mail. We'll put Noah's address on the. No, you can.
You guys can come to my place.
CTL@bhsusa.com. Well, I want to thank Noah Rosenblatt, my good buddy. Finally had you on the show. We'll have to have you on again. It's always fun to talk to you. Thanks for making the trip from Connecticut.
Thanks for having me.
At least the weather's mostly okay today. And we're going to have some special shows coming up. We're going to be live from the Real Deal Forum. Not live, but we'll be recording from the Real Deal Forum. And we're going to have Candace and Melissa next week on the podcast talking about their great show and how they talk about building wealth through real estate and financial education. So make sure you tune in for all that, and make sure you have a great week. And we look forward to doing this again.